Good afternoon, ladies and gentlemen. Thank you for coming to this afternoon session. It's titled Navigating the Regulation Nightmare in Offshore Transactions, which is a slightly dramatic title given to such a dry subject. And I suspect that either you've wandered into the wrong session or you think that we might skip through this fast enough to give you a fast track out to the cocktail party afterwards. We'll try and do both. My name's Martin Livingston. I'm a partner at a firm called Maples & Calder, which has a presence in a number of offshore jurisdictions, including certain onshore jurisdictions. I head up our regulatory financial services practice, and so unfortunately the topics of today's session are our bread and butter. There's no avoiding that. I'm very honoured today to be able to introduce my co-panellists. And to my right, I have Gonzalo Jales, who is the CEO of Cayman Finance. And in that role, he has to keep a finger on the pulse of many policy developments, not only within the Cayman Islands, but also internationally. Gonzalo's background has him latterly working at HSBC for the last 10 years, and his most recent role there was as Managing Director of HSBC Cayman. He's also been President of the Bankers Association and a member of many consultancy groups and committees in the Cayman Islands on policy development and legislation. And to his right, we're very pleased to have Robert Snedeker from the Regulatory Fundamentals Group based in New York. Robert's a managing consultant, and his group or firm advises and assists investment managers and investors in the fund space. So similarly, they are embedded in the US regulatory developments, and we're very thankful to have Robert give us his perspective from the US today. If you were to try and draw a thread through each of our presentations today, there's one common theme. I'm going to be, first of all it'll be Gonzalo, and Gonzalo's going to have a quick look at FATCA. And for those of you that are new to FATCA, we might have to apologise up front. I'm conscious that this conference in particular, and many others, has been delivering a session on FATCA for the last couple of years. So we've made a slight assumption that you're already schooled in the basics of FATCA. Gonzalo, I believe, is going to be focusing more on where we're at now, with a particular focus on the IGAs, the intergovernmental agreements. Robert's going to give us his perspective from the US looking outwards, the onshore legislation that's creeping offshore, with a particular focus on Dodd Frank and the CFTC rules and any attendant requirements coming out of that might affect you and your business offshore. And lastly, I'm going to be looking at two other acronyms called AIFMD and EMIR. And up until about a month ago, I thought an EMIR was a very important person in the Middle East. Unfortunately, it's not, or it's not at least solely that. It's another EU form of regulation that is mirrored on the US side under one of the titles of Dodd Frank. So as you can tell, there's obviously a common theme here, and really the session could have been retitled The Extraterritorial Application of Onshore Legislation Offshore. But if we had titled it that way, I think we probably would have got half the audience here. Nonetheless, that's going to be the focus. In terms of structure, each speaker is going to give you about 10 or 15 minutes presentation of their slides, which should leave us about 10 minutes at the end, hopefully not cutting into any refreshments afterwards for Q&A. But being on the graveyard shift, we're very conscious of timing, and we also realise that we are the three men that stand between you and sex on the beach, which I understand is the featured cocktail this evening at the sponsored event. So without any further ado, I'd ask Gonzalo to kick things off with his rundown on where we stand with FATCA.
Okay, thank you. Thanks everybody. Thanks again for choosing to be here. You probably heard about FATCA many times and from many people. but probably it's going to be a few times you hear about FATCA from somebody that is not an accountant and not a lawyer. So I'm going to try to tackle it a little bit differently, being a banker and an economist. Oh, sorry, what happened? Just didn't stop. That's why I was already looking at strange faces and said, what's going on?
Round of applause for Gonzalo. That's
quick.
exactly what we need.
There you go. It's staying there. Okay. So, is again moving. Why does it do that? Okay. Don't touch it. So basically, law passed in the US. The objective is to find a way to get foreign institutions to report information about suspected US residents. How is that achieved? Well, that's basically achieved because the US still holds, at least for the time being, the world's reserve currency and the means of payment. So effectively, if you touch a US dollar, whether you invest or not in the US, after FATCA and you decide not to comply, you are subject to 30%. I'll keep looking back to make sure we're in the slide. Somebody let me know if it moves.
I'll keep you on.
You are subject to 30% withholding tax that is easy to imagine that basically renders any business absolutely impossible. So it's basically about gathering information to confirm that the people, that the end taxpayer is paying the taxes that they should pay. So intergovernmental agreements were developed to implement it, and I'll get in a second to why. Let's see if I can. Okay. So who's captured as basically, as I said, anybody that touches US dollar, and FFI is defined as anybody that, again?
Yeah. Got a mind of its own, this thing. There we go.
So anybody that holds assets, whether it's cash or any financial asset for third party, is deemed a foreign financial institution that can decide to be compliant or non-compliant. From an individual perspective, anybody that has US indicia. And the definition of US indicia is fairly broad, although it has been narrowed a little bit with the regulations as they are coming. But I would propose that we should assume that FFIs, given the cost of being found non-compliant is so high, will rather fail on being too conservative and report or ask questions to anybody that has any kind of US indicia. And that can be whole mail instructions, a US address, although it's not explicitly there, even a high US consumption pattern that shows that a person is spending significant amount of time in the US. So what is the problem when this started to be implemented, other than obviously the significant cost of implementing this regulation? Yes. The problem obviously started to be the laws in the other countries, confidentiality and protecting customer data. So in response to that and the concerns from several countries and several institutions, two intergovernmental agreements were developed, intergovernmental type 1 and type 2. During the Model 1, or through the Model 1, sorry, the institutions do not need to sign to the IRS, and they report to their local government, which in turn will report information to the IRS. On the Model 2, the government doesn't collect the information, but basically mandates that all institutions in that country need to become compliant, in other words, sign with the IRS and submit the information. In both cases, there are benefits in terms of deadlines and in terms of no need to withhold initially, at least. So most countries have started to sign IGAs, and I'll get back to that in a second with more detail. But basically, the trend at the moment is that most of the EU and most of the overseas territories and the offshore financial centers are signing Model 1 IGA. Japan, Switzerland, and Bermuda, among others, have chosen the Model 2. So how these models work, I briefly mentioned. Under Model 1, everybody is deemed compliant at the beginning. You only need to register.
Yeah, gotcha.
Yeah.
Yeah.
You're going to have to register in a website that should be up and running by mid-July, and the deadline is October. Based on the information, the IRS can ask for more details if there is somebody found there that might not be complying with tax. Responsibilities of like a responsible officer or acting as withholding agent or confidentiality concerns are resolved under IGA 1. And that's clearly one of the reasons some countries have chosen it. Under Model 2, the institutions need to register, as I said, and send information directly. Some of the extensions of deadlines and time to comply, if there is a suspicion of non-compliant, are a little bit shorter than IGA 1, but still longer than under no IGA. So with that very quick introduction, I'll get to my main focus here, which is the next slide, if it stays. There was a lot of media and discussion of whether or not countries are going to sign IGAs. And in fact, many of the opposers and the lobby of trying to stop FATCA were based on governments are not going to sign IGAs, and this is very difficult to implement, and it's completely going to fail. So I thought it was going to be useful from where I stand is to share with you basically how is that industry in Cayman decided that we wanted IGA 1, discussing with government, and that was our recommendation. So I listed there the main factors considered. Number 1, obviously, is government cost and responsibility. Under IGA 1, government has to collect the information and send it. That is going to be a cost for government. And the responsibilities in terms of enforcement and making sure that people are properly reporting are significant for the government. So in that line, IGA 1 was the worst option. Under IGA 2, the information is not collected, it's cheaper, but the government still has some enforcement options. And under no IGA, obviously, government has no responsibility at all. So that's why I put the dots red, yellow, and green, starting with IGA 1. In terms of time frame, as I briefly mentioned, the deadlines have been moving. They seem to be fixed now, but we only know over time if they are not moved again. But it's clear that under IGA 1 are significant extended deadlines versus the other options. So that was a consideration, and clearly having the IGA gives the institutions more time to prepare. Reputation of the jurisdiction was a major one. Cayman has for over 20 years have been signing TIAs and complying with every international standard. And for us, reputation is very important. So in terms of being seen as a compliant jurisdiction and a jurisdiction that wants to help other countries enforce their taxes, signing an IGA was much better than not signing one, and clearly IGA 1 was better than IGA 2. Not having a direct contractual obligation with ARS was a clear plus for some service providers in Cayman. Having to comply with the local legislation instead of start signing legal binding contracts with authorities outside Cayman. Offering memorandums obviously is a very big thing for Cayman based on the number of funds that are in Cayman. And under no IGA, there was a clear requirement to amend some offering memorandums, or at least in every single new offering memorandum include the fact that the fund was going to be reporting to the IRS if in fact they were going to. Risk of FFIs being challenged by customer. There were some concerns that under no IGA, a fund that decides to report to the IRS might be challenged by customers. And of course, any IGA resolves that issue. And overall cost for the jurisdiction, clearly this is a monster. It's going to be very expensive to implement. But our conclusion was, and in particular because of what I'm going to talk in a minute, was that over the long run, for the jurisdiction as a whole, IGA 1 was going to be a little bit more cost efficient than non-signing an IGA or signing IGA 2, because there's basically one agreement to be signed in between two governments, and then the institutions need to comply, submitting the information to the local government. Enforcement responsibility. Clearly, government has a strong responsibility under the IGA 1 and under IGA 2 and none under no IGA. So that's basically a quick summary of a few months of consultation with industry and how is that we ended up with IGA 1. And I suspect that many other jurisdictions are doing similar analysis and ending up with IGA, despite some of the media and lobbyist expectations and comments. If we can stick to the next slide. When I was talking about cost, I clearly say some of the things that I was going to manage farther ahead. And back then, we already started to suspect that this was the beginning and not the end. And we are already seeing that with activity from many other countries. The US is probably the only country that could have forced FATCA the way it was done. That doesn't mean that other governments don't want to do the same. It only means that probably they can't, because many institutions could choose not to use other currencies, but not the US dollar. We are clearly seeing that already. After the US, first of all was the UK, forcing crown dependencies and overseas territories to sign a similar agreement to whatever they were going to sign with the US. So you already have all these countries committed to complying with the UK the same way that we're going to comply with the US. After that, we have a lot of initiatives, and some at the same time and a little bit contradictory, between the OECD, the G5, the G8, the G20, and even I get mixed up of which each one is proposing. But only a few weeks ago, we had the G5 proposing to do something similar between the 5 of those countries in terms of automatic exchange of information. Cayman was the first offshore center to say we want to be part of that pilot. We want to sit at the table, discuss how we're going to do it, and comply in exchanging that information with you. After that, other countries were added. And just today in the FT, there are news that Brussels is proposing that all of Europe is pushed into this automatic exchange of information. So clearly, now it's more clear than ever that IGA 1 is going to be cheaper than anything else, because otherwise you're going to have individual institutions having to sign with 40, 50, who knows how many countries. So what are going to be the challenges? And I'm still running out of time. The challenges, I think, when we try to come with a common system is who should be reported, different tax systems, different dates in those tax systems, how to deal with good reasons for confidentiality, and so on. Lastly, and I feel I'm running, next slide.
Gotcha.
Will FATCA stand? There have been probably pushed by lobbyists some academic papers proposing that FATCA was not going to stand. I did this slide about 2 weeks ago. I think it's a little bit less relevant now that we know that other countries are pushing. But some of the arguments that were proposed on why FATCA should be repealed and was not going to stand are the ones that I listed there. First of all, the cost outweighs the benefit. Probably for the economy as a whole, I would say that might be true. But my main counter-argument is that the costs and the benefits are asymmetrical. The governments will see the benefits, not the costs. The industry overall are going to see the costs. The politicians clearly think that this is a good idea in terms of their aspirations, so I don't think that argument will hold. Discourage foreign investment in the US. If it was only affecting the ability of investing in assets in the US, yes, but the reality is it affects anybody that touches a dollar, even if it's not investing in the US. So I think it's extremely unlikely that it's going to significantly affect investment in the US. Fails to consider the impact of existing tax treaties and foreign laws. US is not the only country hungry for revenue, and we see that many other countries are not only willing to comply, but to ask for similar systems. And lastly, FATCA is an EMIR for American expatriates. I would say, so what? Yes, many banks may decide to stop touching US residents, but there's always going to be banks willing to service them. So I strongly believe that FATCA is here to stay.
Thanks very much, Gonzalo. Okay, we'll probably have a proper session for Q&A at the end, but while things are fresh in people's minds, if anyone has a question on FATCA, feel free to ask it now. Okay, moving right along then. Thank you again, Gonzalo. Robert.
Great, thank you. So I'm going to talk about U.S. regulations and their extraterritorial impact. And to start off, just an overview of the U.S. regulatory regime. The U.S. is a multi-regulator environment, so that means that they're at the federal level and at the state level there are different regulators, and at the federal level there are multiple regulators, and you shouldn't expect coordination between them. So looking first, people with U.S. operations may trigger oversight over non-U.S. entities. That's going to depend on the industry. Obviously in the financial services space, it's very clear that U.S. operations facilitate exposure to things like the Foreign Corrupt Practices Act, sanctions programs, discovery requests, and the like. Focusing on firms without U.S. operations, on the screen you see a bunch of different triggers, and it's important from the non-U.S. entity perspective to focus on what are those triggers. So offering or selling your securities in the United States, offering them to U.S. persons outside of the United States, soliciting those clients, entering into contracts with U.S. parties, and the like. So focusing on those triggers is important to figure out what activities you may want to continue, depending on what regulation exists and what may not be worth it. Focusing on the financial services space, if you go to the next slide, you'll see some of the broader laws that are triggered. So executing transactions on U.S. exchanges, you obviously have insider trading considerations. Antitrust is a big one that's popping up. There are multiple regulators, the Department of Justice, the Federal Trade Commission. Private citizens can bring suits against organizations for antitrust violations. Data privacy protection. This is a state-by-state issue, so you have to think about the issues where your investors are located if you're operating a fund. Sanctions programs, the Office of Foreign Assets Control has broad enforcement authority. They're certainly interested in following up on these issues. Bribery and corruption is a related topic. You have the Foreign Corrupt Practices Act, so that extends to payments to foreign government officials. Definitely an area where the SEC's Foreign Corrupt Practices Act unit, as well as the Department of Justice unit, has been active frequently, and then general anti-money laundering issues. So those are some of the broader laws that apply when you have a U.S. nexus. If we go, oh, here we go, Dodd-Frank's impact. With the goal in mind that Dodd-Frank was aimed to protect the financial stability of the United States and also protect consumers, a few issues impact offshore advisors and offshore funds. And first and foremost, a lot of the issues that have been dealt with relate to SEC registration. So for people who are based outside the United States who might have U.S. investors or U.S. funds or other investment vehicles, there's a de minimis exemption. Once you surpass a certain amount, it's $25 million in assets under management, you have to register as an investment advisor with the SEC. If you're based in the United States, it's a higher threshold. Another big development out of Dodd Frank is the Volcker rule. So this is going to impact investments made by banks. Still in the proposed phase. There have been a number of comments, and we're all awaiting to see where that lands. Another big thing that's going to be driving a lot of the regulatory efforts out of the United States is the creation of the Financial Stability Oversight Council. And what this is an organization that's designed to promote the stability of the United States, and it's composed of different regulators from a number of agencies, and the end result is going to be that a lot of the regulations are going to be more bank-like regulations. So that's sort of a theme that's going to be running through all of the new regulations that come out of the United States, that have come out, and that are going to be coming out shortly. And the next biggest change is the Title VII, the new swaps regulatory regime. And what this is a complete overhaul of the system, trying to take everything from the OTC market and bring it onto cleared transactions. So one of the side effects of the new swaps regulatory regime is CFTC oversight. And this is prompted, one, by now certain types of swaps are considered commodity interests. Another thing that's brought a lot of offshore advisors into the CFTC regime is the rescission of a commonly relied upon exemption that was typically available if you operated an offshore pool and had, or onshore pool rather, as well, and had sophisticated investors. That's been rescinded, and as a result, a large majority of advisors now have to register with the CFTC for the very first time. But there are certain exemptions that are available. Well, actually, first we'll go to the key triggers for CFTC jurisdiction. You're advising U.S. investors, whether you're doing a managed account, whether they're investors in a commodity pool that's advised by an offshore entity. Affecting commodity transactions on U.S. exchanges is another trigger. And then entering into the swap transactions that are considered, quote, commodity interests. If you hit these triggers, you may be eligible for an exemption. The most commonly relied upon exemption from CFTC registration is the de minimis exemption, and you can meet one of the two tests that are shown on the screen. This is common for a lot of people who have limited trading activity. A lot of funds of funds are having issues with this because they can't calculate the underlying interests, but there's forbearance until further guidance comes out on this. An interesting point on the de minimis is that it's hitting a lot of private equity advisors who use interest rate swaps as part of financing arrangements. So they're sort of an unintended consequence of the whole redefinition of the swaps marketplace. So they need to carefully consider any new swaps that they enter into, whether they exceed the de minimis threshold, which is measured at the time that the swap is entered into. A couple other exemptions are available. Those are listed on the screen, but it's a very low threshold for that. If you fit within one of these exemptions, filing for the exemption is quite simple. It's a web-based system, but you do have to monitor your continued compliance. You do have to reaffirm on an annual basis, and importantly, exempt from CFTC registration doesn't mean exempt from all CFTC regulations. I'll give you an example. 2 weeks ago, the SEC and the CFTC jointly passed new identity theft red flag rules, which require you to take certain steps if you're subject to the rule. So a commodity pool operator, a commodity trading advisor, to have a program in place to prevent identity theft. So that's something that if you are SEC registered, you don't have to do it. If you're CFTC exempt, you do have to do it. Going on to CFTC registration. So CFTC registration is effectuated by registering with a self-regulatory organization, the National Futures Association. And essentially there are two options: full registration and what a lot of advisors rely on, registration light, which is just a slightly reduced regulatory regime if you have qualified eligible persons, which encompasses non-U.S. investors and certain investors that meet sophistication thresholds. Registering imposes a pretty broad new regime. Marketing materials need to be revised, so particular focus is on performance data, hypothetical results, actual performance results, use of testimonials, so that all has to go through a process. The regulators The NFA actually has a pre-screening process that's available, so it can assist people who are unfamiliar with the regime. Other things, disclosure statements on offering documents need to be included. Account reporting needs to go out on a monthly basis or on a quarterly basis, depending on your registration status. Systemic risk reporting. The CFTC has a corollary to the SEC's Form PF, and obviously the similar stuff that's coming out of Europe with results to the AIFMD. A lot of overlap in what's required to be reported. There's substituted compliance if you're also registered with the SEC. Ethics training is another new requirement. So those who are registered have to go through a set of procedures to make sure that staff's properly trained on an ongoing basis. Supervision requirements, making sure that staff understands what they've been trained, that there's proper oversight. Disaster recovery is something that's particularly focused on over on the East Coast. They were affected by Hurricane Sandy in October, so there's been a renewed interest in disaster recovery and business continuity plans, and this is a requirement if you're CFTC registered. You have to fill out ongoing questionnaires, and there are proficiency requirements. So anybody who's a principal of the firm needs to pass the Series 3 exam. Anybody who's soliciting interests on behalf of a commodity pool needs to pass the Series 3 exam. But if you're just subject to the CFTC because of swap activity, there is a narrow exclusion from that. So that's an overview of the CFTC regime. I'll focus for a minute on the new swaps marketplace, and what this is not really about regulation, but sort of how to approach the regime. So there are 4 types of entities. You have swap dealers, major swap participants, and those are really the large players. Then you have financial entities, which a lot of the funds, advisors, they all fall within this financial entity category. And then there's commercial end users, so people who are using swaps for bona fide hedging, so oil companies, for example. I'll focus today on the financial entities, and we'll look at an example from the perspective of a fund. The first 2 questions you're going to ask really figure out what are your options for transacting in swaps and what level of oversight are you subject to. First question being, is the fund a U.S. person? If you go through the questions, you can figure out based on the definition of U.S. person, are you covered? A fund that's not a U.S. party is only subject to the swaps regime when it enters into swaps with U.S. counterparties or over U.S. platforms. The second question, is the fund a, quote, eligible contract participant? Again, a defined term, but this is the threshold for who can enter into bilateral swaps and the types of platforms that you're able to enter into these on. So it's really 6 major questions that need to be addressed. How is the fund organized? So which of the 4 categories I listed before are you in? Does that change your registration requirements? As I said before, authority split between the SEC and the CFTC, so depending on what types of swaps might impact the registration requirements. How can you enter into a swap? Can you do it bilaterally? Can you do it on what's known as a swap execution facility? That's a more sophisticated platform that you have to be an eligible contract participant for, so a sophistication threshold. Or if you don't meet that, you execute it on a more traditional exchange known as a designated contract market. Are new contracts going to be required for execution and clearing? Again, it's going to depend on what sort of platform you're trading on. Certainly, if you decide to join one of these platforms, you're going to need to complete a contract for membership. There may be capital requirements, and you have to renew your clearing arrangements, whether it's with your FCM or your prime broker. They may have their own margin requirements as well that need to be considered. Another issue, record keeping and reporting. Record keeping is 5 years, covers all the swap transactions. And reporting generally is covered by the major swap participants or the swap dealers. But in the instances where you're still entering into a bilateral agreement, you may be responsible for reporting that to a swap data repository. And then counterparty risk has changed a little bit. You have the traditional risk with your swap counterparty, but you also have the risk with your clearing broker, your FCM or prime broker rather, and then you also have it with the clearinghouse. And that's actually one of the critiques of this change, is that it was designed to take risk out of the market, but instead it's actually consolidating risk into the clearinghouses. So Whether or not that's successful is yet to be seen. All of this just sort of leads into a way to navigate this regulatory environment, have a baseline of what your connection is with the United States, figure out what specific activities bring you within the jurisdiction, your contractual arrangements, your legal requirements, and then as you engage in new activities, as new regulations are passed, you can figure out what your obligations are.
Brilliant. Thanks, Robert. Thanks for doing that at a fair clip too. There's a lot of information there. I should have said at the start, these slides are going to be available after the conference. They'll either be emailed or available through the website facility. As I mentioned at the start, you know, this is all about extraterritorial application of foreign law, and that's a relatively unthinkable concept about 5 years ago. And through a combination of the financial crisis as well as attrition, it's now become the standard rather than the norm. And it's not only the case in the offshore jurisdictions, as pointed out by Gonzalo's session on FATCA, which affects every other jurisdiction outside currently the US and also any other FATCA partner country, as well as the United States in terms of Robert's presentation, but of course with our friends over the trench in relation to the EU as well. And that's going to be the focus of my presentation today. I'm going to look at two major initiatives there. Once the slides are up, and I've misspelt the first one, which is a great start. The EU AIFMD is the first initiative. Unfortunately, this is going to focus pretty much on the fund sphere, and EMIR, the one I talked about earlier, actually looks at essentially the mirror image of what Robert's just been speaking about in terms of Part 7 or Title 7 of the Dodd Frank Act. And EMIR is essentially in relation to OTC derivatives regulation in the EU. Well, what is AIFMD, apart from a mouthful? It's the European Alternative Investment Fund Managers Directive. For those of you that have heard of this or may have had clients asking you questions about this, it's been in the pipeline for the last 2 to 4 years actually. We've had the higher level, the primary legislation was enacted back in the middle of 2011, and essentially that gave everyone 2 years to get their act together, to bring in regulations and then to transpose the directive legislation into their own member state legislation. Well, the regulations were put out at the end of last year, and every country now needs to have their laws in place by July 2013. Hence, it's very topical at the moment, especially in the fund sphere. The good news about AIFMD is because it's an EU proposal, the United States is as much subject to it as the rest of the offshore jurisdictions. So in some ways, we're quite keen to see how our neighbours react to this. The main objective about the AIFMD, as well as any of the kind of regulation that we've been speaking to today, is essentially to try and address some of the systemic risks that arose out of the financial crisis. And in this case, it gave the EU perfect opportunity to regulate more heavily the funds market. And it's mainly focused at the fund managers in terms of its requirements, but of course that has a dilutive effect on the funds that they set up as well. Essentially, what it's going to do is change the way funds are marketed into the EU. And up until now, for those of you that aren't familiar with funds and funds marketing, up until now, funds have essentially been able to be marketed into EU member states on the basis of what they call national private placement regimes. So in other words, if you've got an agreement in some way with the jurisdiction that you want to market the fund into, then that's been sufficient so far, as long as their requirements are reflected in your offering documentation. That's a concept that will be permitted to continue even alongside the AIFMD, but there may be certain points in the process at which that will either be removed or phased out, or it might possibly be the case around 2018 that a jurisdiction may opt to continue with that regime. And instead, they're going to replace it with a passport regime. So in other words, of course, with any passport, you have to apply and you have to be essentially qualified to be able to market your funds in under that passport regime. you've got to meet certain conditions before you get there as well. Obviously, those conditions hinge around some of the issues that were identified coming out of the crisis, the main ones being transparency and reporting, not only to the regulators but also to the investors themselves. Well, an AIF is obviously an alternative investment fund, so that's the fund, but what you may not see there is that the way it's been drafted is that it can catch anything or other things outside of what you would typically think of as a fund, and it may include certain structured finance vehicles. And this is making our friends in the capital market space very nervous at the moment because it might catch some of the CDOs, CLOs, etc. that are out there. The AIFM is itself the manager. And then looking more importantly down at the definition of marketing, it's a direct or indirect offering or placement at the initiative of the manager of the fund that it manages. There's a very important point there because one of the exemptions that might apply is the fact that if it's a passive marketing or if it's a reverse solicitation type marketing, then you may fall outside the scope of the AIFMD. Some of the other exemptions are value-based. Obviously, for hedge funds under 100 million euro, if you're a manager of those kind of hedge funds, then you fall outside. Or private equity funds, your limit is 500 euro. I'm not going to go into this slide in detail. Suffice to say, it pretty much catches everything. It certainly catches EU managers of EU funds, for a start. It also catches non-EU managers of EU funds or non-EU managers of non-EU funds that want to market into the EU. And so in that sense, it actually catches a lot of the managers that are based out in the United States, as well as those that might be incorporated in places like the Cayman Islands and other jurisdictions outside of the EU. So what do we need to do in these jurisdictions in order to comply with the AIFMD, bearing in mind that July 22 is bearing down upon us? Well, there were three very simple conditions that needed to be met in order for you to be eligible, essentially, for the passport regime. And thankfully, coming from the Cayman Islands perspective, we were able to meet them. The first one is that you need to essentially have signed up, or the regulator of your jurisdiction needs to have signed up an MOU, a Memorandum of Understanding, with the EU member state regulators for purposes of transparency and cooperation. Now, whilst the Cayman Islands has not yet signed those MOUs, essentially what they've been trying to do from the EU side of things is make the process a little easier. ESMA, the securities regulator for the EU, has put up its hand to say we will essentially negotiate these on behalf of the 27 EU member states, and if we deign it that your jurisdiction meets the criteria, then we will sign, or at least we will have each jurisdiction sign the same agreement across the board. The MMOU is essentially based on an IOSCO MMOU, so if your jurisdiction is a signatory to that, then it's in good stead for execution of the actual AIFMD MOU by July 2013. Another criteria relates to AML and combating the financing of terrorism. As long as you're not currently regarded as an FATF non-cooperative country or territory, which I believe only 2 jurisdictions are at the moment, then you're okay. That's another condition you can tick the box for. The final thing, of course, tying all these threads together in terms of how we're going to clean up the financial crisis mess, main point being is cooperation and information exchange, and in particular in relation to tax in this instance. So one of the criteria is also that you have to have signed up a TIEA with each of the 27 member EU jurisdictions. I've just put a little fact there. We had 11, I think that was late last year, so we may have actually increased the numbers from the Cayman side. There is this push, I should say, as a little segue on the OECD side for looking at signatories to another multilateral memorandum of understanding on the OECD, and it's questionable whether if you do sign up to that MMOU, you might have a faster track for becoming a signatory to TIEAs with the EU member states. In relation to the MOUs itself, and sorry for the multiple use of acronyms here, I'm sure that when you come out of this place you'll start thinking like Sesame Street characters in terms of the letters that we've thrown at you. Not Muppets, that is to say. I'm not using a Goldman Sachs term, just for the sake of that. But in terms of the MOUs, what you might need to put in place in your own jurisdiction needs to reflect essentially the equivalent principles in the EU jurisdiction. So if you come from an offshore jurisdiction like I do, you need to marry up some of your financial services legislation, the powers of enforcement under those pieces of legislation, with the same powers that the EU securities regulator might have. And in this instance, in terms of the draft MOU, you need to have covered off certain areas. The ability to be able to freeze or sequester assets is an important one there. Suspend the issuance, repurchasing or redemption of a fund's interests. And be able to impose sanctions on any entities for non-compliance. Just anecdotally, we did go through this exercise in the Cayman Islands trying to marry off those principles with what we currently had under our financial services legislation, and where we identified that there may have potentially been a gap, we shored it up by amending the legislation, and that was gazetted today. So in other words, there's no chance of a challenge that the Cayman Islands is not actually fully satisfying the first recommendation of being able to sign up and enforce the MOU. It's quite important, other provisions in the MOU is the fact that the offshore regulator, or offshore to us, the onshore regulator, any EU regulator, may have the ability to conduct an on-site inspection in your jurisdictions. Just another side effect of the application of extraterritorial law. I won't go into this slide in detail. Suffice to say that once you become subject to the AIFMD, there are a host of other requirements that you need to meet outside of just the marketing restrictions. Depository requirements, custodian requirements. You'll have heard a lot in the press about the staff remuneration restrictions. Certainly that's affecting most of the investment managers in the EU at the moment. It's obvious that there will be certain transparency and disclosure, reporting requirements in other words. Restrictions in terms of the conduct of business, risk management. And for us, there's quite important principles in place in relation to the ability to delegate functions. So for example, where your main manager might be within the EU, but decides to sub-delegate certain management and advisory functions to other jurisdictions. So in terms of where we stand with the AIFMD, this is a potshot of the things that are going to affect us over the next months and years. As I mentioned, there's this phased-in transition from the private placement regime to the passporting regime. Essentially, that's going to be reviewed in 2015, and ESMA, the securities regulator, is going to put together an opinion as to whether each certain jurisdiction meets the eligibility requirements for a passport. They then give that opinion to the European Commission, who then assesses it, and then the European Commission have the decision-making power to turn on that passport regime for that particular jurisdiction. You are allowed to opt out of that. If you're an EU member state, you can continue with the national private placement regime up until, as I mentioned, 2018. And then again, it goes back to ESMA and the European Commission to determine whether or not those should be continued. Skipping across to EMIR. I can summarise this. I'm aware that we've probably gone a little bit over time, and I'll quickly go through this, just sufficiently enough for you to be able to mention it in your cocktail conversations and come across as charming. EMIR is essentially the same thing as Title VII for the Dodd Frank Act, and it was a regulation of the OTC, the over-the-counter derivatives market. It came in just after the Dodd Frank legislation in August 2012, and they're still ironing out some of the kinks in terms of what they call the technical standards. But because this came in not as a law, it came in as regulation, essentially it's binding on all EU members. So they don't need to transpose this into each member state's particular specific legislation. The technical standards are where the meat is on the bones, and there are over 20 technical standards that apply here, most of which are actually in play now, some of which still need to be finalised. The key ones have been finalised. In terms of its application, it's directly applicable to any EU-established derivative counterparty, and indirectly, that's to those outside the EU, to non-EU counterparties that trade with EU counterparties. So that's where the extraterritorial application lies. Interestingly, it applies to both financial and non-financial counterparties. So in other words, most of the stuff, like Robert was saying in terms of the registration requirements, still will apply to most players in the derivatives market. It's just that once you're through the hoop or hurdle there might be some exceptions that are available to you in terms of some of the obligations. One of the exemptions for non-financial counterparties where you're not using a clearing counterparty, and I'll go into that on the next slide, is where there's a value threshold for your derivatives transaction, and that's European 1 billion for credit and equity derivatives or 3 billion for FX interest rate and commodity derivative transactions. There's also an exemption that might apply in terms of the clearing obligation, which I'll discuss in a moment, for intragroup or deferral for pension schemes. So the main obligation is the fact that if you are going to enter into a derivatives transaction, you need to clear it through what they are now calling a central counterparty. And that central counterparty needs to be authorised by ESMA. So they need to go through a process themselves to become qualified to become a central counterparty. The deal with a central counterparty is they act for both sides of the derivatives transaction. That is supposed to lessen risk. In some cases, it certainly will for the actual trade counterparties, but as Robert quite rightly pointed out, it consolidates the risk with the central counterparty. So suffice to say their authorisation procedure is going to be quite strict for them. All of the derivatives transactions also now need to be reported to trade repositories. And in terms of trade repositories, we're talking about the DTCCs of this world, so the hitherto known as the clearing agencies, that will hold that information and make it available to the supervisory authorities. So it's now fully transparent. All of what was up until the crisis, derivative transactions used to be privately, bilaterally agreed. It's now, that information is fully disclosable to the authorities and held on public registers. For anyone that chooses not to go through a central counterparty, you will have certain additional requirements, main ones being risk management and mitigation standards, including a requirement for exchanging of collateral, and more importantly, the higher capital requirements. So questions of capital adequacy now creep into the derivatives markets as well. Obviously, there was concern arising out of the crisis in relation to credit default swaps and whether or not people could actually stand by their obligations. And the higher capital requirements is meant to address that. These are some of the questions that if you're in this sphere yourself or if your clients are in this sphere, you should be asking yourselves. How does the EMIR regulation affect you or your client? Exactly what should you be doing, who should you be focusing on, and who should you be contacting in relation to making sure that you meet this, the criteria for eligibility. Making sure that your trade repositories are aware of your stance, your position, and if you need to delegate to certain parties, whether it be the CCP or the trade repository, then putting that delegation in place. As I mentioned at the start, in order to be fully transparent, this was going to be a dry session, and I'm sure it is. I'm sure it's actually worked up the thirst of many in the audience, but you'll be thankful to know that that is the last slide. We have probably 2 or 3 minutes left. I don't anticipate any questions because if I was sitting where you were, I'd be blinded by science right now. But if anyone did have any questions, by all means, feel free to ask it of the panelists now or approach us later on under an umbrella and a salary stick, and we'll try and answer them there. Okay, if not, I'd like to thank my co-panelists very much for attending.
Thanks, everybody.